Welcome to Real Estate I Love It podcast. I'm Shelly Hoffman, real estate expert and community advisor. Join me and various guests who are expert in what they do, such as home inspectors, mortgage brokers, investors, wholesalers. There are so many aspects to our industry that most people are not aware of, and I'm here to help you learn about them. I'm an educator by trade, and this podcast is to educate you in the world of real estate. Hey everybody, it's Shelly Hoffman with Real Estate I Love It, and I am super excited today because I had these two gentlemen reach out to me, and I am interested by what they have to hear or say. So this is Stoney and Lennon from Passivo Real Estate Investing. How you guys doing?
Hey there.
Great.
Thank you for having us.
Good to see you. Thank you.
So first off, kind of, if you wouldn't mind introducing yourself, maybe Stoney, we could start with you. Give us a little bit of your background, how you got into the real estate industry.
Sure. Well, I'm, as many people are in commercial real estate, I'm an engineer. In particular, I'm an electrical engineer. And I got my start not in real estate, but in technology as an engineer might. And I've worked in the space program in the Apollo program, actually, back many years ago, and got into telecommunications and worked in that field and started a couple of fiber optic companies and some other companies in the telecom space. And then I retired a number of years ago. And but in the meantime, I had been interested in income producing real estate. I'd read a book many years ago about it and was interested in it. So throughout my career, I did some investing, but mostly in residential rental properties, small ones like the vacation condos. And then later on, I got into the commercial space about 5 years ago and met Lennon, who can talk about that some more. But then we've been investing in commercial ever since, and really have enjoyed it, and really just love the space.
Very nice, and that's interesting. I have a cousin who works for the Space Center, or at least he did. He was out in Texas for a while, and I always loved telling people I had a cousin that was a rocket scientist. I thought that was the coolest thing when I was a kid. So, Lennon, we're gonna we'll throw it to you and tell us a little bit about yourself.
Sure. So I'm also an engineer. I moved to the United States in 2010. I'm originally from Venezuela. Moved with my family here in 2010. I did my master's in engineering management here in FIU. And then I started working in logistics and supply chain management for a startup company, labels printing company down here in Miami for a couple of years. While I was doing that, I was managing my family's real estate portfolio. It was a lot of work. A lot of dealing with tenants and the whole thing and contracts and everything. I also got my license after 2015 or so, when we actually decided to start selling some of those properties to try to look for some vehicle within real estate. We always like real estate, but some vehicle that would allow us to not only get better returns, but also that would allow us to be more passive. Definitely for my parents, that was something very important. So we found out about multifamily real estate and commercial real estate and how stable and consistent cash flow it provided. And it was pretty much in line with what we were looking for. But more importantly, we found out about real estate syndications or private offerings, where this vehicle allowed us to really be passive investors and give our money to these companies and groups that were putting together and structuring these huge deals, multi-million-dollar deals that we didn't think we were able to be a part of, as individual retail investors, as we call ourselves. But that was a vehicle that was open and to us, so we started investing there. Ultimately, I decided to get into basically build a business to start offering families and investors like myself and like Stoney the opportunity and the education and telling them, hey, there's this other vehicle here in real estate that might make sense for you. So Stoney and I met at a CCIM luncheon event here in Miami about 5 years ago.
Can I interrupt for 1 second? Can you just tell us what that acronym is for anybody that doesn't know?
Yeah, Stoney, you're the CCIM.
Yeah, I'm a CCIM designee. That's a certified commercial investment member. It's a specialty designation for commercial real estate brokers primarily, but also other people who want to deal in investment quality commercial properties.
Great, thank you. Sorry to interrupt, Lennon, but go ahead.
No, not at all. So yeah, so we met there. I had a deal that I was investing in at that point, 270 plus units in Dallas. I was raising capital for that deal. Stoney was one of my first investors, and from then on, we started investing together on a few deals as passive investors, and ultimately we got into the active side and started building or structuring these deals and these offerings ourselves. And now we've been about a year and a half ago, we started Passivo, which is basically the brand to formalize our partnership and a brand that's going to allow us, and a company that's allowing us to continue to grow in the commercial real estate space, doing more deals and bringing more investors with us to invest on the deals. So that's where we are right now.
Well, thank you for explaining all that and telling us how you kind of got together. There is a real estate investment club that I'm a part of here, and that was the first time I'd ever heard about people kind of joining in, and getting other investors to contribute to buying maybe a larger apartment complex or a strip mall, something like that. Correct? If I'm understanding what you're talking about.
Yes, definitely. So it's called real estate syndication. It's basically pool investments. Bottom line, it's just a bunch of people pulling together resources, mainly money, of course, but also all the other resources, knowledge and contacts and relationships and everything, so that we could be able to invest and tackle larger deals that we would be able to do on our own. And then, of course, take advantage of the economies of scale and all the advantages of investing in commercial real estate deals that are typically larger deals that you don't really have on the residential space, especially if you are, if you are looking to be a passive investor where you have, maybe you're a physician or a professional somewhere else, and you want to have you want to be in real estate, but you don't have the time to be buying or flipping houses or anything like that. You just want to be a passive investor and have the advantages of direct ownership of real estate without having to do any of the management, property management, deal with tenants or renting or anything like that. So
a lot of people will contact me just because I am a real estate broker for one company, associate broker for another, and ask about, buying properties and being a landlord. And they don't really understand the tediousness sometimes of it. So then you can hire a property management company to manage it for you. However, you do need to stay in contact with them, right? Because like in everything, there's good, the bad, and the ugly. Yes. The one question that I had that was brought up, and I don't know, Stoney or Lennon, if you want to answer this, but when somebody comes and said, would you like to invest with me? A lot of times there's that red flag, right? Like, what does this mean? Can you talk a little bit about let's say that I wanted to invest with you, but I really didn't want to be hands-on. What type of information would you give me? How would you explain the process to me if I'm somebody new that's wanting to get into that type of passive investment?
Sure. Stoney, you want to?
I'll start it off, and Lynn is mostly the guy that really communicates with our investors and knows that really well. But what we do is we analyze properties ourselves and do a full financial analysis, and we do market analyses, including the submarkets, to make sure that they're in the right locations. And then we pick out investments that we think will be attractive to our investors who want to invest over a time period, a life of an investment, which might be from 3 to 5 or even 7 years. And then we'll do all the vetting of that deal. We might partner with other operators who can also bring a deal to us, and who are people we know and we've developed relationships with over time. And so we've got a number of criteria that we use in that whole process. But we have a very kind of strict process that we follow to analyze the whole deal. And then Lynn, I think, can explain some more about it.
Yes. So basically, the conversation is pretty straightforward at the macro level, right? And then there's a bunch of details and a bunch of questions to be answered once people are interested. But bottom line is we are identifying. Right now, we're strictly focused on multifamily properties. Okay, and these are large apartment complexes. The smallest property we've bought, it's 138 units. That's the deal that we bought in Jacksonville that we're actually selling right now. That was a couple of years ago that we bought it. So we buy apartment complexes. These are stable businesses, 90 to 100% occupied. We buy them, and it's property that's cash flowing from day one. So we buy the whole property. One of the first questions that people that are not familiar with commercial real estate ask is like, well, are you buying like condos and you buy a bunch of condos? And like, well, not really. A condo, it's an apartment complex that everyone it's owner of their own apartment. And a multifamily or commercial multifamily property, it's a property where you are the owner of the whole property and you rent all the units. Okay, so apartment communities, rental communities, all that's all multifamily. So we buy those businesses that are, again, cash flowing from day one, and we go in and we invest some money into renovating some of the units. And when we do that, we can increase the rents. And if we're able to increase income or decrease the expenses of the operation, that immediately translates into more value for the property. So basically, what we do is we buy the property, we get cash flow from day one for all of us and for the investors, while we implement the business plan of renovations. That takes us a couple of years, and then we hold the property for another 2 years to take advantage of the cash flow, of course, but also the appreciation that the property has had, not only because of ideally the market, but because we forced the appreciation of the asset. So at the end of the investment cycle, when we sell, our investors have had the benefit of cash flow every year, but then also another bump at the end from the appreciation. So we're typically looking for properties or deals that are going to allow our investors to overall generate somewhere around 15 to 20% returns every year. Okay, and that's basically, again, that's the big picture. But that's what I do.
When it's important for people to see the big picture, right? Because again, you have a lot of people that do not have the time, or they're not understanding the property or the operational expense of everything, right? And that's where someone like your company would come in there and be helpful. Another question I could see people having would be, what's the amount of money that they have to invest? And I'm sure that varies depending on the company. You know, your company might have one limit, another company might have another. But generally speaking, you know, if I've heard sometimes where, you know, neighborhoods pull together to do something together, like to buy something smaller. So that's a small scale thing. Obviously, you're larger than that. But if somebody is watching this and listening, what's a number that they should shoot for to have to be a part of something like this, to get that 20%, you know, return on investment in a commercial passive investment? 50,000?
Yes.
Okay. Is there a maximum at all that somebody would have?
Yes. And, you know, and this goes because, for example, you can only, and this is going to take us into a deeper conversation of legal structure and everything. But yes, there is a maximum. Typically, it's going to be 20% of the whole equity piece of the deal. And the reason it's 20%, it's because after someone owns more than 20% of the deal, whether that's one of us or one of our investors, then at that point, that investor is going to have to be on paper, but basically analyzed by the lender, you know, because again, we're talking, for example, the Jacksonville deal, right? And we bought that deal for, I think it was like $12 million. We had to raise $4.4 million. And so we're basically getting a big loan, a big chunk of money from the lender. And the lender wants to understand who's involved in the deal that at least has more than 20% or obviously in our case, you're going to be the operators and managers, then we need to underwrite you guys. So we keep our investors under that 20% threshold so that they don't have to deal with any lender underwriting or have to be liable for anything other than their investment capital. So that's why our investors are ultimately under the structures that we do these deals or these offerings on. They're called the limited partners, and we're called general partners. So the limited partners are going to be bringing the money. They trust our team and our track record and everyone to do everything else. They just bring the equity, and obviously we share in the deal, and that's it. They're not going to be liable if someone sues the property or anything. Their only liability is the money that they've invested. So.
Right. And the reason I ask that question is because sometimes people think there's not that much involved. If you have the money, you just kind of go in. There's all kinds of legal things that are involved, especially when you get into the higher end properties, that people just in real estate in general. I always say real estate, no deal is ever the same. The more that you do, the more education, the more knowledge that you have with it. Right.
No, yeah.
What was, so Stoney, I'm at 13. What was the first one that you and Lennon did together that made you decide that you could be a good team to work together?
Well, that was a deal in Dallas, Texas that I invested in. It was a property, I don't remember the number of units, 264 or something around that number, but it was
272.
in a 272, was it? Okay, good. I'm glad Lennon's around here to help me out. Okay. Anyway, it's our standard model that we've been investing in, which is to take an existing profitable business, and that's what an apartment building is. It's a business, and but it's underperforming. So we go in there, and the key thing is make sure it's profitable first of all, because the main thing we want to do is preserve the investment capital of our investors and our own families. And then we want to make it have a profitable business because we want it to be standing on its own. We don't want to have to keep on feeding it to have to keep on going. And then we want it to have some upside so that we can do that forced appreciation that Lennon was talking about. And that way we know that we can identify a property that is underperforming. So we know that there's all kinds of different ways to help improve the performance of the property by either renovating individual units, by sprucing up the outside, the exterior, so it looks better, providing some extra amenities, a package, a locker, a dog park, maybe the laundry hasn't been updated properly, other things like that there might be. So we do all of those things. And the ultimate reason for that is that unlike residential property or real estate, commercial property is valuated based on its income, its net income, and it's not dependent upon the market in general for the local neighborhood. So that's what really enables us to have the control of that property. And then the investors, we keep them up to date every month on the activities, and they have us to talk to as well or ask questions of the property. They can drive by. It's an actual private piece of real estate that they can actually see that they own a piece of. So it's all part of that.
So they get almost like a balance sheet or something that shows what's coming in, what's going out, where their money's in essence being spent. Would that be correct?
Yes,
they get all the financials. Oh yeah, we have the P&L, the balance sheet, all of that. We send that out quarterly. They have a portal that they have access to all the property documents. In fact, there's a legal set of documents at the very beginning that they have to read through and make sure that they understand the investment that they're getting into and they're investing in. And that way it's all regulated too by the SEC to protect all the investors. So it's very up and up, and a lot of paperwork that we have to go through, but it's worth it in the end.
Yeah. I think what I wasn't expecting to hear from you guys that you both had talked about is finding that property that is rentable, right? It's not a slum piece of real estate, but it's livable, but there's still room to improve on it, because that's where your return on investment is going to be. Like you said, like to take a property, there's different, I do a lot of residential, I do some commercial, but there's always those people that want to buy, we call it the HGTV property. They don't want to put a dime in it. They want to move in. It's perfect. Right. I got to believe there's investors out there as well. Like they appreciate the fact that you'll take that property, even though it's functioning, make it just a little bit better so that when they buy it, you'd mentioned you were selling something, I think, Lennon, when they buy it, it's basically running at operation. I'm sure there's things you always have to do, but they're getting a very top return on investment because of what you did to the property in the time that you owned it. Am I correct?
Yes, 100%. And that's a question that a lot of investors ask whenever we are either buying or selling a property, because when we're buying a property, we're telling the story, okay, there's this deal, it's pretty cash flow, and it's in a good location, workforce housing type of deal, which is what we focus on, 80s to 90s properties on average. And some of our investors are like, well, if it's such a good deal, why is the guy selling? And it's like, well, there's a bunch of reasons, right? Like, first of all, there might be another group. They might be a group like us that they have investors. They implemented their plan. They got to that point, and they want to realize their returns at that point, and they want to give back the money to their investors. That's one of the reasons. Or maybe the type of financing that they used for that deal. And unlike residential, long-term commercial loans are 10 years, not 30. There are 30-year term loans, but it's a different conversation.
Yeah, it's not common. Yes.
Yeah, typically 10 to 12, that's long term. Even 7 to 12 up and up, it's long term, right? So if you've held, and maybe you have a 5-year loan, right? So if you've held the property for 5 years, well, at year 5, you have to either refi or sell. Well, maybe it's time to sell, and it is, and you implemented your plan, and that's your business model as a company. Then that's that. And then on the other side, we have people, okay, but who's going to buy the property now that you added all the value? Now there's no upside. Well, there's no upside, but then of course there's less risk, right? And you have a solidly high-performing property at that point. We took it from non-performing, cash flowing, but we added the value. Now there are groups, mostly institutional groups, that are more conservative than we are, and they have a different business model that we have. And that's the people that are going to buy from us. They want a property that they don't need to have spend a lot of money on CapEx budget or anything. They just want a solid cash flowing property. And that's the people that buy from us. So there's a bunch of people, a bunch of different groups out there doing and implementing different business strategies. We try to play. We found that our model, it's pretty much in line with what our investors are looking for, which is, first of all, Stoney mentioned that capital preservation. Okay, don't lose my money. Then we can talk about how much cash flow, how much growth, and all that, but don't lose my money. All right, and then we have a strategy to invest so that we position ourselves in a way that it's very unlikely that we're going to lose money. Then how do we? Okay, the property is cash flow, and then how do we grow that money? So I forgot where I was going with that, but ultimately, yeah. Capital preservation, it's one of our core strategies, I guess. And then we talk about it.
Well, and it's funny you said their main thing is don't lose my money. I got to believe no matter what business model you have, that concept of don't lose my money is pretty strong. But there are, and that's what people do not understand. When you're investing in real estate, there's different business models. And there are some people that really want that. This is almost condemned, right? Yes. And then there's the people that want, hey, this is high functioning and I don't have a lot of time. I don't want to deal with repairs. And maybe I'm wrong, but I feel like you guys are kind of in that middle of the road, right? Yeah. Like you don't really want to take something that's in complete disrepair that you have to start from scratch and rebuild. But there are people that's what they want to do. That's what brings them the satisfaction, is taking something that's not functioning, make it a functioning property, then turn it over to someone like your company, yes. Right? And you take it to the next level. And then there's somebody at that next level as well. So yes. For anybody that didn't quite follow along, that's the kindergarten version of what he just said. Yes. Obviously there's a lot to it. And the fact that you can lay it out as detailed as you did shows that is what you guys tend to do. Cause that's what I got.
Yeah. And now I remember what I was saying. So the idea is that in this space, like in the middle, we find that we have ways to preserve capital, but we also have ways to grow that capital. So we have some upside, and we find that the balance, it's right, for the risk return. There's something called the Sharpe ratio and investing, where that basically takes into account, it's a formula that takes into account not only what the returns are, but also the volatility of the investment. And that ultimately tells you, okay, how good this investment is, not only looking at the returns, because if I can tell you, well, let's invest in Bitcoin, right? Or something like that. Well, I can tell you, well, you're going to do 100% returns in 2 days. Well, hands down, that's the best investment. I don't want to talk to anyone else. Well, that doesn't make sense, right? If you don't take into account what the risks are or how volatile the investment is, then you're not really doing anything. So we found that commercial cash flowing, a private ownership of commercial real estate, especially multifamily, and something else that people might get confused with is multifamily. It's residential in the sense that people live there, obviously, but in terms of the way it's financed and the way it's valued, it's a commercial property if it's 5 units or more. With that said, we found that commercial multifamily and being direct owner of these properties have the best Sharpe ratio of most all investments out there, including the other types of real estate investments and other types of of course, what is it? So stock market and notes and bonds and all that stuff.
Right. Another question that I kind of had for you before we got to the airs, I wasn't 100% sure if it was, to your point, anything 5 units or larger, because 4 and under is residential, which again, that's probably where I deal a little bit more. If I wanted to get something involved in something larger, I would have to work with gentlemen like yourselves, because I don't really have the background, the knowledge to, and you guys have done a lot of research, obviously. But what is it about the multifamily, the larger apartments over maybe a strip mall or something? Because obviously that's another form of commercial real estate. What drew you to that apartment as opposed to going to a strip mall commercial investing?
Well, I think Lyndon almost hit it right on the target there with the Sharpe ratio. The Sharpe ratio measures that reward to risk, and the volatility of other asset classes is significantly higher. Especially outside of real estate. Real estate overall is a little more or less volatile and more stable. But there's 4 basic asset classes, if you will, or categories of commercial real estate. You have office, retail, industrial, and multifamily are the main ones. There's obviously a lot more in subcategories, but multifamily by far is the most stable, the most, I'll call it, recession resistant. It's not recession, proof, but its performance during the subprime cash flow recession during the 2008, 9, 10, and during the pandemic has been much better than other asset classes. And now the only other one that's been close to it during this last pandemic is industrial, and they're kind of first and second in the commercial spaces. But if you think about it, and we've seen, and I think people have read that retail and office have been impacted by the pandemic. For multifamily, people have to have a place to live, obviously, and in our case, our class of property is in the middle. It's a B class, and so when there's a recession or problems and people can't afford their places, they'll tend to either sell their houses and move into apartments, or maybe move from a more expensive class A into a B like we have. And then when the economy is booming better, then they'll move up from the C class into ours a lot of times. And so there's a lot of different advantages to that category and that type of property. And so we feel like in looking at all the studying that we've done over time, that's a big advantage. Back during the subprime, to get back to that, the private residences typically had a very high foreclosure rate, whereas multifamily had a very low. It was less than a percent. It was down to 0.4% of even delayed payments for that. And then during the pandemic, the impact was more of more of late payments rather than no payments for rent. And the government, of course, payments and support of rent in different ways. Even though we had eviction moratoria, then people still had enough money to pay their rent, which was critical to them in many cases. They didn't want to be have to leave, and so it was very low. Typically, most properties that we saw were less than a percent or maybe 1.5% of delayed payments, and so it's been a very strong asset category.
Yeah, one other big thing what is the non-correlation that you see between multifamily properties and the economic cycle. Of course, when you have a retail, industrial, or office property, that's all businesses, like literally businesses that are there. So if the economy is doing well, then that's probably going to do well. So you're always more correlated with, well, the stock market and everything else, how the economy works. In multifamily, of course, you're going to have some of that, but you don't really, like people, and it's a cliche, because people need a roof over their heads. We always say that, and of course that's true. But it's a cliche that it was, like Stoney said, it was just proven. Like people were getting some people, of course, you're always gonna have people that are gonna take advantage of the payments and the eviction moratorium, and they're not paying, and you can't take them. You can evict them. That's okay. That's fine. But most people actually care about where they live. Like, okay, if I'm gonna lose my business, so be it. If I'm gonna lose my car, so be it. Whatever. But I can't lose my home, right? Like, and I'm already here, so I better at least try to work with the managers to, maybe I can't pay the full amount, but I'm still gonna pay. So our business model was very much proven on when we saw that during this crazy, last couple of years, we were so far away from losing money. Yes, some of the properties suffer in terms of cash flow, so the returns, instead of being, let's say, 8 to 9% per year, we went down to maybe 4 or 6 or whatever, depending on the property. But most properties were still cash flowing, right? So a lot of our investors were super happy because, listen, this is the craziest thing that could have happened. Pandemic, who would have thought? And bottom line is we're not only not losing money, but we're making money, still good money, way better than being on a U.S. Treasury note or an investment, some other investment. So, that's a bunch of reasons for multifamily and commercial real estate in general.
Well, that's perfect, because that was actually my next question, was if, the pandemic had hurt you, made you maybe go a little bit in the red, but it sounds like you were able to stay out of the red, even if it wasn't the amount of money you were used to, right? But there was a lot of people that just lost so much in 2020. So, well,
yeah, the importance of that's why, like I was mentioning, capital preservation is our main thing, right? So one of the big things for capital preservation, or the main one, I would say, is cash flow, right? If you're cash flowing, you don't really care if the property value goes up or down. Because, well, if you're not selling, then why do you even really care at that point? I mean, there's some reason why you would care, but my point is that you're not losing money if you're not selling the property, right? Even if it went down in value. So if you have cash flow, you're still making money on your investment regardless of the value. Well, how long can you do that? Well, then you have, what type of financing do you have on the deal? Because if the property is cash flowing, then you don't care about the value, unless you are forced to sell the property or refi. So if you have the right debt, if you have long-term debt, maybe you have a business plan of 3 to 5 years, and you have a 10 to 12-year loan on your property, then you're going to be fine, because first of all, you're cash flowing, and if the market goes up or down in a 10 to 12-year period, you're probably going to end up on the other side pretty well. So you don't have to realize that loss of value if you're not forced to, because you have the wrong type of financing. And well, those are the way we think about buying and structuring our deals. Those are two of the main components for capital preservation. It's very hard to lose money if you structure it and you think about it that way.
Well, go ahead, Stoney. I apologize.
No, I'm sorry. If I could add one more thing there, and what we do for each property we acquire is we go through a thorough underwriting process or a financial analysis of it, and we model a number of scenarios that might happen that are different than what we think is most likely. So we take a look and see how that impacts the returns, the profitability, and so forth. And so we look at the different inflation rates, at different growth rates of rents or expenses and so forth. And we look at all that to make sure that it's a good, solid investment. And one of the key metrics that we look at is the break-even occupancy. We look at a whole bunch of them, but that's one of the key ones, which tells us what percentage of units are occupied that it makes it still profitable and still break even. And that typically is around 70% or less on a lot of these properties. So it's got to go a long way and have something really severe to go from in the 90% percentiles and down into the 70. So it's one of the key, another one that is among numerous other metrics that we look at.
Well, it's interesting to hear. I teach real estate to new real estate agents as well. And one of the little chapters, right, is about investing in commercial property. And how do you figure out the return on investment? So they say typically you have to account for almost 6% of vacancy, right, when you're running your numbers. So if you're saying that you can almost have 10% of vacancy and still be profitable, right there, that tells people that it's more than what typically is vacant. But if it needs to be vacant, or in the case of the pandemic, you're getting delayed payments or maybe less payments, it allows you to run those numbers, correct? Yes. And figure out what you can do, what flexibility you have in order to stay profitable, but work within what you can't control, right? If you do it all in the beginning.
Yeah, and each market has its own unique characteristics that we use to help us to make a realistic assumptions and to look at the variations. Because we only go into good growth markets and into the better submarkets within each of those markets or MSAs. And so we look at that, and 6% is a common, typical percentage that some people use for a vacancy. But our break-even occupancy again is 70%. So that means it's a 30% vacancy that it could get up to before it starts to break even.
Nice. So obviously, if people are interested in this type of investing, they can reach out to you, which I'll have your contact information within, the YouTube and the Facebook part of this. But if you want to say, because some of this is going to be a audio podcast, what would be the best way that people could get a little bit more information about your company?
Sure. So, well, the first thing I would like to tell people that if they want to understand a little bit better why we do what we do and how we think about, just basically our investment philosophy in general. We have this ebook for free, of course, at Passivo, and you can have that on the notes, passivorei.com/dream. And it's our way to look at what we call, so it's called 4 Investing Rules for the New American Dream. We think that the new American dream, it's, well, definitely different from what it used to be 50 years ago. And we think, syndications and commercial real estate and investing through this type of vehicles is a good way to get there. So that would be one thing. And then if you can always go to our website, passivorei.com. You have on the top right corner, you have a bunch of buttons that say invest with us. You click in one of those, it'll take you to our investor portal. You can register there, and then it'll prompt you to set up a call with us, get on the phone, see if it's a good fit that for us to invest together. We can obviously educate you, and you can become part of what we call the Passivo Investor Network, that you're going to have access to deals, but also to a lot of education resources that we give our members, so that so we can ultimately, bottom line, we want everyone and ourselves, of course, to become better passive investors, and so we're always happy to talk to people about it.
Perfect. So I have one other question. I always do the good, the bad, and the ugly, just because, you know, when you're out in the world and people are talking to you, and let's just say that we're at the grocery store, we go to an investment club meeting, and someone talks about what you gentlemen do for your company. You've obviously talked to different people in your industry, people that do the same thing that you do. Some are successful, some are not. Is there anything that within a conversation that somebody should understand would be more of a red flag to get involved with anybody? Something that you've seen repeatedly that maybe somebody's starting out who's trying to be successful, who's trying to build, you know, people to invest with them, that anybody should avoid? Because part of what I like to do is educate people for what not to do or what to look for so that they don't get taken advantage of. You know, you guys have a track record, you have social media, you have a website, people can kind of follow what you're doing. But if you're just having a conversation with someone and they say, hey, you should, I'm going to buy this apartment complex down in Texas. Is there anything that, you know, is kind of a red flag, like I said?
Yeah, well, the main thing for everything that we do, it's based on relationships, whether it's a relationship that we're going to have with a broker to get a deal, or with our investors, of course, or some other operating partners that we might be joining forces with to tackle a deal. It's all relationships. So it comes down to alignment of interest. So as an investor, if you are an investor, then you want to make sure, okay, is this person selling me this project because he's gonna just make a commission? Like maybe he's the broker of the transaction. Well, that's awesome. Obviously, I also have my license as well, and you know that's great. But that person's gonna make money whether you lose money or not. Like, you know, it has nothing to do with what happens with the actual project. That person's gonna make money. So you might want to invest with someone that actually has their interests aligned with yours. So only if you make money, they make money, especially if they're the ones offering the property, the deal to you, right? So only if you make money, they make money. How does that look like? Well, we could talk, you know, for another 20 minutes about it, but just think about it as a whole. That's something that you want to have in mind: alignment of interest. And yeah, I don't know, Stoney, what do you have?
Yeah, I think I'd say exactly that. And how you can find out about the alignment of interest is another red flag, which is if they don't have a private placement memorandum, an operating agreement, and a subscription agreement to offer you, which is legally required by the Securities and Exchange Commission, then that would be a red flag. Except for, you know, a very small deal where the investor is also going to be operating the property and going in with maybe 2 or 3 other people at the most. Most of the investments, all the investments that we do anyway, are regulated by the SEC. They're 506B or 506C investments. They're all requiring very detailed legal documents that are prepared by SEC attorneys. And so a person who's investing in something like what we do has all those alignment of interest indicators in the documents, in the PPM, the private placement memorandum. The operating agreement expels out exactly what is offered, what the fees are that are charged by the operator, and so forth. So that would be a red flag if it doesn't have those documents.
That is, of course, for the passive investor, right? Like, those are kind of our main plan. If you're going to be on the active side, meaning you want to buy these type of properties, then that's a different conversation. But yeah.
Perfect. So, well, I appreciate it. Is there anything that when you two were talking about coming on the show today that you wanted to make sure that you talked about that I didn't ask about or we haven't covered yet?
I don't know. I think this was very fun. I think we shared some good nuggets out there. So yeah.
Perfect. So, well, I appreciate your time. I definitely have learned a lot. It's something that when I look at the word passive, because I think we work so much, we're so busy in life that anytime you can have passive income coming in, it's worth learning about, listening to, and hopefully participating in. So thank you, gentlemen, for your time.
Well, thank you for having us.
I would say that we try to help our investors become better investors and financially literate in more ways than just in our real estate. So I think that's important. And I think this is a really good way to get into real estate for people who don't know a lot about it.
Well, I was going to say, you definitely have a lot of knowledge and you're obviously willing to share it, which is key, because sometimes people like to hoard everything and they don't like to share it for fear that they become competition, right? If there's one thing about real estate, there's enough out there for everybody. And the more that we work together, usually the better it all ends up being profitable for everyone.
Absolutely.
I agree more.
All right, well, gentlemen, well, thank you again. I appreciate your time and enjoy the rest of your evening.
Thank
Bye.
you.
Very good. Thank you.
That's it for this week's episode of Real Estate I Love It. Be sure to subscribe and leave a review on whatever stream platform you're using for your podcast. See you next time.